Why are Treasury securities so significant in financial markets? They play a crucial role due to their volume and liquidity. In this video, we will explore the types of securities issued by the Treasury and federal agencies. Treasury securities are vital because of their large volume and liquidity. The U.S. Treasury is the world's largest debt issuer. This makes the Treasury market highly active and liquid. The dealer spread between bid and ask prices is narrower than in other bond markets. This ensures efficient trading and pricing. Marketable Treasury securities are divided into fixed principal and inflation-indexed securities. Fixed principal securities include Treasury bills, notes, and bonds. Treasury bills are issued at a discount and mature at par value. Treasury notes and bonds are coupon securities. They differ by their maturity periods. Treasury bills are discount securities with no coupon rate. They are issued for 1 year or less. The return for investors is the difference between the purchase price and maturity value. This makes them unique in the Treasury market. Their issuance is part of the Treasury's regular cycle. Treasury notes have maturities between 2 and 10 years. Bonds have maturities greater than 10 years. Both are coupon securities issued at approximately par value. They provide regular interest payments to investors. This distinguishes them from Treasury bills. Introduced in 1997, TIPS adjust for inflation. The principal is adjusted semi-annually based on inflation rates. This affects both the coupon payment and maturity value. TIPS offer protection against inflation. They have become a popular investment choice. The Treasury auction process is crucial for issuing securities. Auctions are announced in advance with detailed offering information. They are open to all entities, ensuring broad participation. Competitive and non-competitive bids are accepted. This process determines the yield and allocation of securities. Auction results include high yield and bid quantities. The secondary market is an over-the-counter market. It offers continuous bid and ask prices. Trading occurs in major locations like New York and Tokyo. The secondary market enhances liquidity for Treasury securities. Treasury bills are quoted on a bank discount basis. This differs from bonds that pay coupon interest. The yield is calculated using the dollar discount and face value. This method can be confusing for comparing returns. The bond equivalent yield offers a more accurate comparison. Coupon securities are quoted on a price basis in points. 1 point equals 1% of par value. Prices are divided into 30 seconds for precision. Yield to maturity is also reported with the price. Accrued interest is calculated for transactions between coupon payments. Stripped securities are zero coupon instruments. The private sector creates them due to demand. They separate interest from the principal, known as stripping. Strips are direct obligations of the U.S. government. They offer unique investment opportunities with no credit risk. Federal agency securities support housing and agriculture sectors. They are issued by government-chartered entities. These include government-owned corporations and GSEs. The market for these securities is significant. They provide funding for specific U.S. government projects. GSEs are divided into publicly owned corporations. Fannie Mae and Freddie Mac are prominent examples. They support the secondary mortgage market. GSE securities vary in price quotation conventions. They play a vital role in the U.S. financial system. The TVA was established for flood control and development. It issues various debt securities in U.S. dollars. TVA debt obligations are not U.S. government guaranteed. However, they are highly rated by credit agencies. This reflects the TVA's financial strengths. Fannie Mae was created to support the mortgage market. It was divided into two entities in 1968. Ginnie Mae uses U.S. government support for mortgages. This division enhanced the secondary mortgage market. Both entities are crucial for housing finance. Freddie Mac supports conventional mortgages. It issues a variety of debt instruments. These include reference bills and euro notes. Freddie Mac plays a key role in mortgage finance. It enhances liquidity in the housing market. Farmer Mac provides a secondary market for agricultural loans. It improves mortgage credit availability for farmers. Farmer Mac sells debentures and mortgage-backed securities. These securities are called agricultural mortgage-backed securities. They support rural homeowners and communities. The FHL banks consist of 12 district banks. They support savings and loan associations. The system issues consolidated debt obligations. These are joint obligations of the 12 banks. The FHL banks are crucial for housing finance. The FSCBS provides credit to the agricultural sector. It consists of three entities: land banks, credit banks, and banks for cooperatives. They issue debt on a consolidated basis. This ensures adequate credit for agriculture. The system is vital for rural development. The RTC was created to address savings and loan industry issues. It was part of the Financial Institutions Reform Act. The act aimed to stabilize the financial sector. It provided a framework for resolving financial difficulties. The RTC played a key role in recovery efforts. GSE securities are not backed by the U.S. government. Investors face credit risk when purchasing GSEs. The yield spread reflects perceived credit risk. It also indicates liquidity differences with Treasury securities. Understanding these risks is crucial for investors. In conclusion, understanding the different types of securities is fundamental to making informed investment decisions and managing financial risk effectively. Securities such as stocks, bonds, and derivatives each offer unique characteristics, benefits, and levels of risk that appeal to different types of investors. By gaining a clear understanding of how these financial instruments function within the market, investors and professionals can build diversified portfolios that align with their goals and risk tolerance. This knowledge forms the foundation for deeper investment analysis and strategic financial planning. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 07,484,361,688.